You know how it is, right? You search online for, like, the best way to invest your money, and suddenly you're just drowning.
Oh, yeah. It's jargon city. Gurus everywhere promising unbelievable returns.
Exactly. It's overwhelming. Makes you just want to, shove the cash into the mattress.
Definitely feels like that sometimes. The finance world can seem almost intentionally complex.
But it doesn't have to be. That's why today we're diving deep into a real classic that cuts right through it all. The Little Book of Common Sense Investing by the late John C. Bogle.
A foundational text, really. Simple, but powerful.
Think of this as your, like, financial reality check. We want to pull out the core wisdom, the practical stuff you can actually use. No complex theories, just actionable insights from Bogle's book.
Right, our mission here is to boil it down. What did Bogle say that can genuinely help you, the listener, build a better financial future? We're focusing on what you can do.
And just to be super clear up front, this isn't about getting rich quick.
Yeah.
No secret stock picks, no complex trading.
No, this is Bogle's sensible long-term approach. It's about common sense, hence the title.
Okay, so let's jump in. Bogle has this central idea. He says investing in stocks should be a winner's game, but most people manage to turn it into a loser's game. What does he mean by that?
Well, the core idea is that businesses over time generally grow. They make profits, they pay dividends. The whole stock market, as a representation of the economy, tends to go up in the long run.
Okay, like owning a slice of that overall economic growth. You mentioned the GDP correlation.
Exactly. Since, what was it, 1929, the correlation between U.S. GDP growth and corporate profit growth is incredibly high, like 0.98. So just by owning the businesses, you're basically participating in that success. That's the winner's game part.
Makes sense.
Yeah.
So how do we mess it up? How does it become a loser's game?
Yeah.
That's where his Gottschalk's family analogy comes in, right?
Right, the Gottschalk family. It's a great little story. Imagine this family, the Gottschalks, own all the stocks in the entire country. Initially, they just collect all the dividends and profits. Simple.
Sounds ideal.
But then the helpers show up. Think brokers, active fund managers, financial advisors, all the intermediaries.
Oh.
These helpers convince different members of the Gottschalks family to trade shares with each other. And every time they trade...
Someone takes a cut,
Uh,
a commission.
Precisely. Then the helpers say, hey, we can pick the better stocks for you, which means more trading, more fees, and of course, when they sell stocks that have gone up,
Taxes.
taxes. So the total return generated by all the businesses stays the same, but the share the Gottschalks family actually gets smaller and smaller because the helpers are taking their slice through fees, commissions, and triggering taxes.
So the very act of trying to do better than just owning everything, facilitated by these helpers, actually makes the average investor worse off. Have you ever felt that, listeners? Like, your returns aren't quite what the market itself did.
It's a very common experience because all that activity, trying to pick stocks, paying managers, frequent trading, it all costs money. And those costs come directly out of your returns.
Which leads us nicely to Bogle's solution, the traditional index fund, or TIF. How does that fix the Gottschalk's problem?
It's designed to bypass the helpers, essentially. A traditional index fund just aims to own a representation of the entire market, or a big chunk of it, like the S&P 500, which is the 500 largest U.S. companies.
Or even broader, like a total stock market index fund.
Yes, even better. It holds thousands of stocks. The key is it doesn't try to pick winners, it just owns the market.
And the crucial part, the real magic, according to Bogle, is the cost, right? Why are they so cheap?
Because they're simple to run. There's no star manager making million-dollar decisions about what to buy or sell. The fund just mechanically holds the stocks in the index.
So minimal management fees.
Extremely minimal. We're talking tiny expense ratios, often hundreds of a percent per year. And because they're not constantly trading.
Lower trading costs.
Right. Very low portfolio turnover.
Right.
Which also means
Fewer capital gains being realized, so it's more tax efficient.
exactly. Think about it, even a 1% annual fee, which sounds small, on a $100,000 portfolio is $1,000 gone every single year. Compounded over decades, it's a huge drag. Index funds minimize that drag.
So low cost, broad diversification, tax efficiency. You're basically guaranteeing yourself a fair share of whatever the market delivers, those business returns, the dividends, the earnings growth.
That's the core actionable insight. It's not about outsmarting anyone. It's about capturing the market's return efficiently. So for you, the listener, considering a low-cost broad market index fund as the core, the foundation of your portfolio is, well, just common sense, according to Bogle.
Okay, but the temptation is always there. People think they can pick the winners, the superior fund managers. Bogle's pretty blunt about that, isn't he?
He is. He basically says they are wrong, and he backs it up with data.
Like that Exhibit 3.3 you mentioned?
Yeah, Exhibit 3.3, it looked at, I think it was 2001 to 2016, and it showed consistently that the vast majority of actively managed funds, often over 80% depending on the category, failed to beat their simple index fund benchmark.
80% fail to beat the average. Wow. That's not great odds for picking an active manager.
Not at all. And the reason, Bogle argues, comes down to what he calls the relentless rules of humble arithmetic. Costs are killer.
Right, the compounding effect of fees. You mentioned Exhibits 4.1 and 4.2.
Yes, they illustrate it powerfully. Exhibit 4.1 shows how, over 50 years, even a small difference in annual cost leads to a massive difference in your final wealth. Exhibit 4.2 shows how just slightly lagging the market each year because of costs eats away at your capital significantly over time.
And Exhibit 5.1 directly links higher fund costs to lower investor returns.
Precisely. Higher costs generally mean lower net returns for you. It's a simple mathematical reality.
It's like trying to fill a bucket with a hole in it. The bigger the hole the costs, the harder it is to fill the bucket. So the actionable insight here is be really, really skeptical of high-fee active funds. Understand that those costs are a direct headwind against your returns.
Absolutely. Minimizing costs is the most reliable way to improve your net results.
Okay, let's switch gears slightly. Dividends. Bogle calls them the investor's friend. Why are they so important?
Well, they're a huge part of your total return from stocks over the long haul. It's not just about the stock price going up.
Right, you get paid just for owning the stock.
Exactly. And Exhibits 6.1 and 6.2 in the book really show this. Reinvested dividends have accounted for a very significant chunk of the S&P 500's total return historically. Exhibit 6.2 also highlights how relatively stable dividend payouts have been over time, much more so than volatile stock prices, even during crises.
So they provide a sort of smoother, more reliable return stream that you can reinvest to compound your growth.
That's the idea. And connecting back to index funds, Exhibit 6.3 shows that lower fund expenses mean you, the investor, actually receive a higher dividend yield.
Because the fund isn't taking as much out before passing the dividends along.
Correct. So another win for low-cost indexing. You get more of the market's return, and you get more of its dividend income, too. It reinforces that core idea.
Okay, but then there's that temptation. Maybe I can just jump out before the crash, or this fund manager is brilliant. Look at their recent returns. Bogle calls this the grand illusion. What's the illusion?
The illusion is that we can successfully time the market, consistently buy low and sell high, or that we can reliably pick the winning active funds before they win. The data suggests otherwise.
Exhibit 7.2, right, showing how investors actually tend to do the opposite.
Yes, that exhibit shows net flows into equity funds. People tend to pile in after the market has already gone up buying high, and then they panic and pull money out after it's fallen selling low. Emotion drives poor timing.
Classic behavioral finance trap. Fear and greed taking over.
Exactly. And the other part of the illusion is chasing past performance. We see a fund that did great last year and assume it will keep doing great.
But Bogle talks about reversion to the mean, or RTM.
Right. Exhibits 11.1 and 11.2 show this clearly. Top-performing funds in one period rarely stay at the top in the next period. They tend to revert or fall back towards the average or even below it. Past success is a poor predictor of future success in active fund management.
So that hot fund might just be lucky, and that luck runs out. And the sheer failure rate is pretty stark too, wasn't it? Exhibit 10.1.
Yeah, that one's sobering. It showed that something like 80% of the mutual funds that existed back in 1970 were gone by 2016. Merged away or liquidated, usually due to poor performance. It's incredibly hard to pick a winner that will even survive, let alone thrive, for decades.
Wow. Compared to, say, the Vanguard 500 index fund he started.
Exactly. He uses that as the counterexample. Simple, low cost, track the market. A $15,000 investment in 1976 grew to over $900,000 by 2016 just by capturing the market return minus tiny costs.
So the actual insight is crystal clear. Stop trying to time the market. Stop chasing last year's winners. Stick to a long-term plan with low-cost index funds.
That's the Bogle way. Discipline and consistency beat timing and chasing.
We've hit on explicit costs like fees, but Bogle also hammers home that taxes are costs too. How do they hurt active investors more?
It comes back to trading activity. Active funds, by definition, tend to buy and sell stocks much more frequently than index funds. That's high portfolio turnover.
And every time they sell a winner.
They realize a capital gain, which gets passed through to you, the investor, and you owe taxes on it, usually at the end of the year. This happens even if you haven't sold any of your fund shares.
Ouch. So you get a tax bill just because the manager was busy trading inside the fund.
Correct. Index funds, with their buy and hold approach and very low turnover, generate far fewer capital gains distributions. They're much more tax efficient, especially in regular taxable brokerage accounts. Bogle estimated a pretty significant difference in the annual tax drag.
So it was yet another hidden cost of active management that chips away at your real take-home return. For the listener, that means considering tax efficiency is important, favoring low-turnover funds like index funds where possible.
Absolutely. Minimize all costs, including taxes.
Now, looking ahead, Bogle wasn't always sunshine and roses. He talked about the possibility of lower returns in the future when the good times no longer roll. Why did he think future returns might be more subdued?
His reasoning basically was that a big chunk of the high returns people saw in the late 20th century came not just from underlying business growth, but also from what he called speculative return.
Meaning stock valuations went up, people became willing to pay more for each dollar of earnings.
Exactly. The price to earnings, or PE ratio, expanded significantly. Bogle argued that you can't expect PE ratios to just keep expanding forever. Long-term returns, he stressed, must ultimately be driven by investment return, the actual earnings growth and dividends the companies produce.
Which is tied more closely to the real economy.
Correct. And if dividend yields are lower than historically, which they were when he wrote the updated editions, and earnings growth may be moderates, then overall future returns might be lower than the blockbuster returns of the past.
He uses that great Benjamin Graham metaphor, right? The market as a voting machine versus a weighing machine.
Yes. In the short run, the market is like a voting machine. Driven by popularity, sentiment, emotion, prices can swing wildly. But in the long run, Graham said, it's a weighing machine. It ultimately reflects the true underlying substance, the weight of earnings and dividends.
So for the listener, the insight is have realistic expectations. Don't bank on repeating the returns of the 80s and 90s. Focus on the long-term fundamentals, the weighing machine, not the short-term noise of the voting machine.
That's it. Control what you can control: costs, asset allocation, your own behavior, and let the long-term fundamentals work for you.
Okay, so if stock returns might be lower, that makes the other side of the portfolio, bonds, potentially more important for stability. What's Bogle's take on bonds?
Bonds play that crucial role of reducing portfolio volatility. They're the anchor, the ballast, especially when stocks hit rough seas. But, and this is key, Bogle applies the exact same logic to bond investing.
Meaning the relentless rules of humble arithmetic apply there too. Costs matter just as much.
Precisely. His Exhibit 14.1 shows that, just like with stock funds, most actively managed bond funds also underperform their passive benchmark indexes over time, largely due to costs.
So the recommendation is similar. Consider a low-cost, broad bond index fund.
Yes, something like a total bond market index fund. It gives you diversification across thousands of investment-grade bonds at a very low cost. Stay away from high-fee active bond managers.
What about ETFs, exchange-traded funds? They're often index-based and low-cost.
ETFs can be great tools, offering low-cost index exposure, absolutely. Bogle's caution with ETFs wasn't about the structure itself, but about how investors use them. Because they trade like stocks throughout the day, the temptation is there for rapid short-term trading.
Which can rack up transaction costs and taxes, kind of defeating the low-cost benefit.
Exactly. Use them for long-term holding, not for day trading. He was also a bit skeptical of the more complex smart beta ETFs.
Right, the ones that try to beat the market using factors other than just market cap, like value or momentum.
Yeah. His Exhibit 16.1 suggested that many of these strategies haven't consistently delivered superior returns after costs and complexity are factored in. He leaned towards sticking with simple, broad, market cap-weighted index funds for most people.
So simplicity wins again. What about putting it all together, stocks and bonds in one portfolio?
He was a big proponent of balanced investing. Simple, balanced index funds, like a classic 60% stock, 40% bond allocation, are highlighted as sensible, low-cost options in Exhibits 19.1 and 19.2.
And that old rule of thumb, bond percentage equals your age. Is that still relevant?
Bogle saw it as a reasonable starting point, maybe, but definitely not a hard and fast rule.
Yeah.
Your personal situation, your risk tolerance when you need the money, those are more important.
What about target date funds? They automate that allocation shift.
TDFs can be very convenient, especially for retirement savings. Bogle's advice was just to look under the hood, check the costs, and see if they're built using low-cost index funds or more expensive active funds. And interestingly, he also reminded people to consider Social Security benefits as a kind of bond-like asset when figuring out their overall stock-bond mix.
That's a good point. Okay, one last area. What if someone feels they do need help picking funds or managing their portfolio? What was Bogle's advice on seeking financial advice?
He was very cautious, definitely warned against picking advisors or funds based on past performance or those star ratings you see everywhere. Remember, reversion to the mean?
It's hard to tell skill from luck.
Extremely hard, maybe impossible over the long run. So he strongly recommended favoring fee-only advisors. Advisors you pay directly for their advice, not advisors who earn commissions selling you products.
Because that removes a potential conflict of interest.
Right. And ideally, find a fee-only advisor who shares his philosophy and recommends a portfolio built around low-cost index funds. He also acknowledged robo-advisors as a potentially good low-cost alternative for getting a diversified index-based portfolio managed automatically.
So even when getting advice, the goal is still simplicity and low cost.
Mhm.
It all comes back to that core message: profit from simplicity and parsimony.
That's the Bogle mantra. Keep it simple, keep costs incredibly low. The historical data he presents, like in Exhibits 13.1 and 13.2, overwhelmingly shows low-cost index funds beating most active funds over time. Even sophisticated simulations like Monte Carlo analyses suggest active managers have a very low probability of consistently winning.
He quotes Warren Buffett too, doesn't he? About expenses and emotions.
Yes, Buffett said, the greatest enemies of the equity investor are expenses and emotions. Bogle wholeheartedly agreed. And even Charles Schwab, founder of the brokerage firm, admitted he'd tell the average person to use index funds because they're highly likely to outperform most other options.
It really is straightforward, isn't it? Own the market, minimize costs, stay disciplined for the long term. Simple concept.
But not always easy to execute emotionally. That's the challenge, sticking with it through thick and thin.
Okay, so let's wrap this up. The key takeaways, the actionable insights from Bogle for you, the listener, are: Number 1, own everything. Get broad market diversification.
Number 2, slash those costs. Use low-cost index funds as your core holdings.
3, think long-term. Decades, not days or months. Avoid climbing the market or reacting emotionally.
4, ignore past performance as a guide to the future. Reversion to the mean is real.
5, don't forget taxes. There are costs too. Favor tax-efficient funds.
And finally, 6, figure out a simple asset allocation of stocks and bonds that fits your own situation and stick with it.
Successful investing really doesn't need to be complicated. Bogle showed it's about common sense, discipline, and controlling those costs.
Exactly. Let compounding work its magic for you, not against you because of high fees.
Which leaves us with that final thought to ponder. Looking at your own investments right now, are you truly playing the winner's game Bogle described? Owning the market, low costs, long term? Or are you maybe letting those helpers and the market noise, the emotions, turn it into something else, potentially a loser's game?
It's worth reflecting on. Applying Bogle's common sense might not only improve your financial outcome, but maybe let you sleep a bit better too. Keep it simple, stay the course.